The global financial system has always carried hidden risks, but rarely do we see the world's largest asset managers sound the alarm twice. Something is happening behind the scenes, something so large, so structurally embedded, and so quietly dangerous that even a firm known for its calm confidence has begun issuing warnings that the private credit bubble may be far closer to bursting than Wall Street wants to admit. The mystery begins with a simple but chilling question. Why is BlackRock, with all its influence over opaque financial markets, suddenly pointing toward a crisis of its own industry? What do they know that isn't being said publicly? And what does this second warning really mean for everyday investors, businesses, and the stability of the global financial order? To understand the gravity of this moment, we need to step back and trace the evolution of private credit itself. Not too long ago, this market was a niche area dominated by specialist lenders quietly financing small companies that banks ignored. But everything changed after the 2008 crisis, when regulators cracked down on banks' lending abilities, forcing them to reduce risk and tighten lending standards. As traditional credit channels shrank, private credit funds rushed into the vacuum. They offered loans faster, with fewer regulations, and with interest rates that were extremely attractive during a low-rate environment. The rise was dramatic, almost explosive. In 2010, the private credit industry was worth just around $300 billion. Today, it has crossed more than $1.7 trillion. And by some estimates is headed toward $3 trillion within only a few years. Yet this rapid expansion was not the natural evolution of a stable financial tool. It was the result of years of suppressed rates, desperate borrowers, investors chasing yields, and regulatory blind spots large enough for entire funds to disappear through. The origins of the problem date back to the cheap money era following the 2008 crash. Central banks slashed rates to zero, and institutional investors began hunting for higher returns as bonds and savings accounts yielded almost nothing. Private credit funds promised returns that looked too good to pass up. But behind those returns was a growing ecosystem of highly leveraged companies kept alive only by access to easy debt. As more money flooded into the system, private credit lenders began loosening terms, competing aggressively and writing riskier loans with fewer protections. This toxic combination quietly planted the seeds of systemic vulnerability. As interest rates remained artificially low for a decade, private credit became the lifeline for companies that might have otherwise failed. Zombie firms, businesses that earned too little to service their debt. And because private credit deals are not traded on public markets, their risks remained hidden. No one outside the industry could see how many borrowers were falling behind. No one knew how inflated valuations had become. And no one understood how many companies were being propped up by refinancing rather than profitability. Everything functioned as long as rates stayed near zero. But the breaking point began taking shape when inflation surged globally, forcing central banks to raise interest rates at the fastest pace in more than 40 years. Suddenly, the cheap debt that had kept thousands of businesses alive became a noose tightening around their necks. Borrowing costs doubled and tripled. Refinancing became nearly impossible. And for the first time, private credit lenders were forced to confront a wave of distress they had hoped would never arrive. Even worse, many of the loans written during the boom years had floating rates, meaning every rate hike directly crushed the borrower under new payments. Defaults began rising. Recovery rates shrank. Leverage became unsustainable, and the quiet cracks in the system began turning into structural fractures. Then came BlackRock's first warning. In it, they hinted that private credit valuations were artificially inflated and distress levels were being massively underreported. For the financial world, this was a subtle signal that the bubble's surface tension had weakened. But now, months later, their second warning has arrived, far more direct and far more alarming. BlackRock states that the private credit market is showing signs of systemic overheating, mispricing of risk, and a buildup of vulnerabilities eerily similar to the lead-up of the 2008 crisis, except this time. Regulators have even less visibility into what's happening. The most dangerous crises are the ones hiding in the shadows, and private credit by design is a shadow market. The fallout of this crisis is already beginning to take shape. Companies that depended on constant debt refinancing are running out of financial runway. Private equity firms holding leverage buyouts are finding their portfolio companies unable to pay rising interest expenses. Middle market businesses are experiencing credit droughts as lenders tighten issues. And perhaps most dangerously, a large number of private credit funds have matched liquid long-term loans with investors who expect short-term liquidity. This mismatch echoes the setup that caused multiple UK pension funds to nearly collapse in 2022. One small shock, one wave of redemption requests, or one high-profile default could trigger a cascading liquidity crisis across the industry. Even more alarming are the failed fixes. Many private credit managers are trying to solve the crisis by extending loans instead of restructuring them, delaying defaults rather than addressing them. Others are marking loans at unrealistic valuations to avoid reporting losses. Some are refinancing borrowers with even more expensive debt, pushing them deeper into distress just to avoid write-offs. These are not solutions. They are. BlackRock's report warns that these practices could magnify the eventual collapse, not prevent it. When we examine modern parallels, the picture becomes even clearer and more disturbing. During the subprime mortgage crisis, risks were underestimated, valuations were inflated, and regulators lacked transparency into the true size of the problem. Today, private credit resembles that pattern, except the numbers are larger and the oversight weaker. In 2007, subprime mortgages totaled around $1.3 trillion. Private credit has already surpassed that 10 is still growing. Default rates are rising quietly, hidden from public view. Corporate bankruptcies are increasing at the fastest pace since the 2008-2009 recession. Many companies financed during the cheap debt era now face refinancing at interest rates 2 to 4 times higher. These repeating patterns signal that the bubble isn't just inflating, it's already cracking. BlackRock's second warning leaves us with 3 major takeaways. First, the private credit market is far riskier than it appears, and the lack of transparency has allowed vulnerabilities to compound unchecked. Second, rising interest rates are pushing leveraged borrowers toward a breaking point, creating a slow-motion wave of distress that has only begun to surface. Third, the industry's attempts to mask or delay losses are increasing the systemic danger, not reducing it. This crisis is unfolding behind closed doors, and by the time the public sees it, it may already have reached a point where contagion is unavoidable. So the final question remains, are we witnessing the early stages of a collapse that will rewrite the global financial landscape? Or is there still time to unwind the risks before they spiral out of control? No one can answer that with certainty, not even Black. But the warnings are on the table, and ignoring them has never ended well in the history of financial markets. The lesson is simple. Transparency matters, debt has consequences, and markets built on silence do not stay quiet forever. If you found this breakdown valuable, make sure to subscribe. Because this story is far from over, and the next chapter may be the most important one yet.